And on Thursday, MBS were up 16 basis points in the morning. Stocks were down 25 points. Bonds were already stronger in the overnight with some flight to safety buying on or around the regional bank short selling. Pacific West is the focus of most of the headlines due to the big drop in deposits. In separate news, Jamie Dimon is out this morning saying commercial real estate could be the next thing that brings down a couple of banks. We got the jobless claims today. Jobless claims came in at 264,000 on a 245 forecast. It was 242 previously. Core month-to-month producer prices, so this is inflation on a producer level, came in at 0.2 on a 0.2 forecast. It was negative 0.1 previously. Year-over-year producer prices came in at 3.2 on a 3.3 forecast. It was 3.4 previously. Headline year-over-year producer prices came in at 2.3 on a 2.5 forecast. It was 2.7 previously. Consumer prices are up 0.4% month over month. Rates will improve, albeit at a snail's pace, as long as the markets believe the Fed will not have to pause rate hikes in June, but will have to start cutting in July 1st. I personally do not think it will play out that way, though. We may see rates creep up a bit to the top end of the range we've seen over the last month, but not likely see them move much higher than that. Western Alliance gave an update on its deposit situation. Total deposits are $49.4 billion, up $1.8 billion from the end of last quarter and up $600 million from last week. Insured deposits are 79% and liquidity covers unsecured deposits by 2x. Pacific West said that its deposits fell 9.5% in the week ending May 5th. Available liquidity is about 3x the level of uninsured deposits. The regional banks continue to be under pressure overall, and the S&P 500 regional bank ETF is down 38% year to date. There are currently a massive amount of people shorting the 10-year Treasury bond. Should inflation continue to improve and rates improve, we could see further improvement from shorts covering over the summer. The bond market rallied on Thursday with 10-year yields dropping about 5 basis points to just under 3.4, with a smattering of bank drama and softer economic data this morning. That said, whereas yesterday saw an AM improvement followed by additional steady gains, today's AM improvement gave way to a bounce with a sideways to slightly weaker trend after that. On the one hand, the rally is a rally. On the other hand, we've been in the same old range for months, and there's a higher burden of proof for a friendly breakout. The other day, we were up 11 basis points on the MBS. Stocks down 7. Treasury was down 5. At 100.98, that is putting us in the upper bounds of this very wide range, with several floors down around 100.792 and the ceiling at 100.34. So these wide ranges tend to be bouncy. In deal news, recall that last month HomePoint Capital agreed to sell its wholesale-only production arm to the Loan Store out of Tucson. Yesterday, news came that Mr. Cooper announced it will buy what's left of HomePoint Capital and its roughly $89 billion mortgage servicing portfolio for $324 million in cash in the third quarter. HomePoint operations to be shut down after closing. Mr. Cooper Group will assume $500 million in outstanding HomePoint 5% February 2026 notes valued at $400 million. Mr. Cooper is currently the nation's 8th largest owner of mortgage servicing rights at $400 billion and will pass Freedom Mortgage when the deal closes. According to the basis points, their analysis shows that Mr. Cooper just tied Wells Fargo as America's top mortgage servicer with $937 billion portfolio after buying HomePoint. We also got a post from our sponsor at wellthatmakessense.com where it talks about what data items impact the bond market the most and why. So this is to help you understand what news pieces and what data items impact your daily interest rate. So check it out at wellthatmakessense.com.